What is going on, everyone? James Livingston here, back again, bringing you guys probably one of the most important videos that I've been asked about, and that's just how I determine what options to get when I'm looking at a trade based on that trade and how long it's going to take, etc. How do I define the strike price that I'm getting in at, as well as the expiration that I go with based on the play that I'm looking at. So we're going to go over it. It's in a couple different tiers. So we're going to hop right on into it here and just get you the facts, exactly what I look for. So first, we're going to start off with ETFs, because there's a difference when it comes to the stocks, like Tesla, Apple, any stock really that has a larger market cap or a mid cap. There's a different process for each one. So with the ETFs, they're going to be a little bit different as well. So let's just say here on SPY, theoretically, let's just say that I am looking for this to go in the up direction, into an uptrend. I'm expecting a bounce here at this point. So if we look out on the larger time frame, obviously my thesis is supported. We're still in an uptrend. Even on the daily here, while we have had a lot of red days, we are seemingly getting a nice push, at least on the last day here as well. So when I'm looking at this, I am eyeing up potential for calls, theoretically. I go into the options chain. So the first thing you need to understand is, when are you expecting said move to happen? Are you expecting it to be a quick momentum push that you are looking to just get in and then get out? If that is the case, if you fall into that category, then you are looking at least one out of the money strike price, and you are going for either 0 DTEs, so 0 days to expiration, or 1 day till expiration. Now I'm going to throw in a disclaimer here, because a lot of people are going to be like, well, James, you told me to hop into 0 DTEs. If you are an experienced trader and you understand with these 0 DTEs, they expire that day. So whatever you put in, if you hold it for longer than the momentum trade that you're looking at, you will lose. They are geared against people unless you trade them correctly. With 0 DTEs, you are looking at moves that are going to happen relatively quick. They're going to happen within, in my opinion, within 15 to 20 minutes. They are moves that you are expecting to happen based on what you're seeing on the lower time frames, the 1 to 5 minute time frame, specifically the 1 to 3, in my opinion. You want to look for those setups if you're trading the 0 DTEs. If you aren't looking at that kind of a setup on the lower time frame, 0 DTE is not the contract for you. If you are looking at a setup on the 30-minute time frame, let's just say you see this kind of a candle, for example, forming out. You see a hammer candle, a reversal candle on the 30-minute time frame, meaning each one of these candles is 30 minutes long. So in this little patch here, this is an hour worth of price action. So if you are looking for a move on this, you do not want to go in with 0 DTEs. The Greeks on the 0 DTEs are geared against you. They are geared to literally decay the contract out till it's worthless. If you understand that, you will not get 0 DTEs for a setup like this. For a 15 to 30 minute setup, maybe up to about an hour, you are now looking at 3 to 5 days out. The reason that you do this, the reason that I go 3 to 5 days out, is because you want to ensure that you are going to have enough time for this to play out throughout the day. Now, this is still a day trade, but you are getting multiple days out contracts for the reason of counteracting the time decay. Okay, so if your setup is supposed to, let's just say it was a hammer style candle right here, like we see, and you were just looking for a push up to the 20 EMA. So you're looking from about 584.60s up to the 586-ish area. So you're going to be looking about 3 days out. So if this is tomorrow, Monday, one has 0 DT, 1 DT, 2 DT, 3. So you're looking at least March 6th. March 6th, you're going to be looking for at least $1 outside of the money. So at that scenario, we would have been at about 584s. So we've been looking at those 585s, which you can see it will give you a retrospect of what the cost was. Cost would have been probably about 400. Yes, it's a little more expensive, but you are protecting your capital. You are protecting the fact that you know that the setup is likely to take a little bit of time to play out. In that case, it would have taken about an hour, hour and a half to play out. Or if you call it this initial pop-up, within the 30 minutes. So that would have been great. It would have been a great trade right there, low risk, and you probably would have came out of that with at least 10 to 15% on that $400 contract. So that is how I look at it when it comes to the day trading for SPY, QQQ. Now, if you were looking at potentially swing trading these, which I do not recommend swing trading the ETFs. I think they're very volatile. They're too volatile. You are almost guaranteed to at least lose money on time decay, which is just not worth it. It's worth it to just wait till the next day. Now, if you know the risks of you holding it overnight, what I would do is get the next day expiration instead of buying multiple days out. If you're looking to swing it overnight, as long as you understand the risk of there's a good chance this could go to zero. So whatever money you put in, whatever money you buy that contract for, if you're okay with the risk of it going to zero, go for it. By all means, that's up to you. That is a gamble. At the end of the day, I don't do a lot of gambling. The lotto, what I like to call them are lotto contracts, is when you have a pretty good understanding of market direction. You can see that there's potential news maybe in the morning, and that you are willing to risk, if it's a small size contract, $20, $30 for a slightly out of the money contract for an overnight swing, and you're okay with losing it, then go for it. That is calculated risk in a way. If you are okay with losing $20, if it's a very small percentage of your profits from the prior day, then go for it. But if you're looking to swing an ETF, like I said, I do not recommend this. But if you want to swing, I recommend going at least 1 to 2 weeks out. At least. If you're looking at the 3rd for tomorrow, the 10th would be the following. You would be looking at going at least a week out. That way your time decay can, or your delta can outweigh your time decay. You can see here the 37 delta, 29 time decay, or 29 theta. As you can see, as we get closer to the expiration, like let's just say Tuesday's expiration, these thetas start to outweigh the deltas. So we want to get into a contract if we're looking to swing trade, aka swing it overnight, or over 2 nights possibly. You want to get ones with lower theta than the delta. That is on any stock, but specifically the ETFs. So that is how I determine which contract I'm going to get. Again, the strike price is almost always 1 or 2 out of the money. Okay, you don't want to go too far out because they are far out of the money for a reason. Yes, again, if the price goes up and hits them, you're going to make a lot of money. Is it worth the risk? No, I don't think so. That's how people lose money in options, especially with the ETFs. Go 1 to 2 strikes out the money, call it a day. Now, let's move on over to some of these other stocks, Apple, Tesla, Nvidia, etc. Similar concepts are going to apply, okay? But in this case, they don't offer 0 DTEs for these other stocks, other Magnificent Sevens. It's still weekly contracts, right? So if you are looking to take a trade during that week in a certain, let me rephrase that. If you're looking to take a trade that day, during the day, you're scalping or you have something that's going to play out that day, you are going to be looking at weekly contracts because you are getting in and out that day. Now, another rephrase on this. That is strictly for, again, the similar concept to the SPY and QQQ, the ETFs, where if you're expecting the move to happen in 15 to 30 minutes, you can trade those weekly contracts. Again, going about 1 to 2 spots out of the money. Now, if you were looking at a trade, again, that is forming on, let's say, the 15 to 30 minute time frame here, you are going to now be looking at next week's contracts. Again, the same thing that we are battling, like with SPY, QQQ, all them, is these Greeks, right? We need the delta to be above the theta if we are wanting to hold. Otherwise, the value of the contract will not hold up against the theta, the time decay. So we would be looking at next week contracts if we're looking at 30, like a 30-minute time frame. So those plays aren't going to play out usually within 30 minutes. They're going to play out within an hour or 2. So you're going to be looking at holding that contract there for a little bit that day. You don't want to see it just continuously lose value up until the point where it actually pops, because then sometimes if you play the weeklies, if it pops, you might not even be in the green. You might be so far in red that it's just back up to break even now, because that's how the contracts move. They move up or down, not necessarily based on if the price action is staying still. If the price action is staying still, the contract is going to go down. It's going to lose value. But you can counteract that with these contracts that are, you know, a week out or multiple weeks out. Now, when it comes to swing trading, again, looking at maybe the 4 hour or daily for your setup, you would be looking at more of 2 to 3 to 4 weeks out, depending on how far of a price target you have, etc., etc. So, like with NVIDIA, I would recommend, if you're looking at a multiple day trade or even an overnight trade, I would get yourself a 2 weeks out contract. It will, again, be significantly outweighed via the delta to the theta, and you'll be able to actually be comfortable in the position. At the end of the day, guys, the biggest thing that keeps people from positions or holding them is because they got the wrong contract in the first place and they were too over leveraged in it, or just not comfortable in it. This way of trading is going to allow you to be comfortable in the contract you took because you know the plan. You always should know the plan. So yeah, that's pretty much it. I know it seems really simple, but honestly, it's just taking it in baby steps. You know, go through the process. Is this a day trade? Is this something that I'm expecting to happen in the next 15 to 20 minutes? If that is the answer, if the answer is yes, then you are looking at either weekly contracts for these mid to large caps, or you are looking at 0 DT or 1 DTE contracts for SPY, QQQ, IWM, etc. If it is a 15 to 30 minute setup on the brain fart, on the Magnificent 7, Apple, NVIDIA, Tesla, etc., you are looking at next week's contracts, because again, you want to be able to hold that with confidence in that certain day without having to worry about time decay. You don't want to worry about time decay. You want to worry about the technicals and what's going on right in front of you in your screen, so you can focus on the actual trade instead of focusing on counteracting time, because at that point you're going to stress yourself out. You're going to see different things on the chart that you shouldn't be seeing. It's going to ruin the whole trade plan from the beginning. So like I said, if you're looking at potentially holding that trade for maybe a couple hours that day, you're looking at the following week contracts for these Magnificent 7. For SPY, QQQ, IWM, you will be looking at 3 to 5 days out on the expiration. And lastly, if you're looking to swing trade on Tesla, NVIDIA, etc., you are going to be looking at 2 to 4 weeks out for your expiration. And then with the SPY QQQ, you will be looking at 1 to 2 weeks out for your expiration, holding it overnight. Again, super risky on the ETFs to be holding those overnight, but to each their own. But that's the general gist of how I pick the options, strike, and expiration. Again, with the strike price, I tend to stay 1 to 2, maybe sometimes 3 outside the money, but I don't really go further than that. It's just too risky. So hopefully that answers your guys' question as far as the options, how to choose the right one. In my opinion, this is the safest method. It's not the most rewarding in terms of getting crazy hitters, but you will still get really nice gains with less stress, which is the most important thing in my opinion. So if you did like the video, please do leave a like, comment down below, let me know what you guys think about these videos, and subscribe if you're new, and I'll see you in the next one. Peace.